Hey, y'all, happy Thursday. Welcome back to another live episode of Tech Backstage. My name is Eddie. I am joined today by Joseph Schneier, CEO at Trusty.Care. Joseph, how you doing?
It's great to be here. And yeah, it's been a pretty good day.
Awesome, man. I'm excited to have you on the show. Excited to talk about fundraising, especially early stage in the recession. I think it's top of mind for a lot of people right now, and it's a topic I hear a lot about. Just being around product development on a daily basis. But before we dive into that, would love to just quickly introduce you to the audience and tell them a little bit about you. So I'd love to hear a little bit about your backstory and how you came to be CEO at Trusty.Care.
Sure. I've been running technology companies since around 2003, and I've seen a couple different downturns, and also this last 10 years that were really something else, and um, have raised capital at each of those companies. So they're all venture-backed companies. So have seen a lot, have had a lot of meetings with investors. I came to start Trusty.Care, which is a company that's focused on streamlining how people get insurance when they need to get Medicare, Medicaid, or like an ACA plan. Um, because my younger brother got into a car accident and didn't have insurance, and I saw how difficult it was for him to get it when he didn't have an HR department to turn to. Yeah, I decided we're going to tackle that and see what we could do to make the health system a little better.
Cool. And you guys are focused kind of on and correct me if I'm wrong here, but it's focused more around Medicare, right?
We actually do. We work with all lines of health insurance that you don't get from your employer, but we started with only Medicare.
Oh, okay, cool. So you got it. Okay, I was reading the tagline there, and I was doing a little bit of reading about the company. I saw Medicare, and kind of piqued my interest there. But I think that's great. I think that especially I don't know when it got so difficult. Maybe when they started making it like requirement to have insurance, but then it's like, do you use the marketplace? Do you get it from your, do you get it from your insurer from your company, or do you like? And then I think there's also like there's state marketplaces now too, and yeah, it can be a little bit of a maze to try and navigate, right?
I mean, it's we have yet to meet a person, no matter how smart you are, PhD, whatever, that when we analyze the health insurance that they chose, that they purchased, that they made the accurate choice of what would actually cover their medications, health needs in a cost efficient way. Um, yeah, it's a
I love
mess.
that. I love that because we were just going through kind of an audit the other day on like an architecture review, and it's funny to think about that you can apply similar learnings and I guess similar practices towards medical insurance because, and I'm probably like 100% guilty of this too. I'm like, what's the least deductible, and how much do I have to pay for that per month? And I think that's how a lot of people look at it. And like like you said, that it's not necessarily the right. And then there's always the, is it an HMO versus a PPO, and like what exactly is the difference? And
Yeah.
yeah, so it's a tough thing to navigate.
And I think the thing that people don't realize, most people who get their insurance through an employer, you're making that decision. It's hard, and you're choosing between five different options like gold, silver, bronze, whatever. But once you get into the situation where you have to purchase it on your own, you also have to decide which insurer you're going to go with, and then all the different types of insurance, way more types of insurance. So it's sort of information overload for a lot of people.
Yeah, I remember having to choose an insurance plan for our company, and that was information overload for me too, because
Exactly.
you're not even just thinking about yourself, but you have to think about everybody else as well. So it's
Yeah.
yeah, it's a tough thing to navigate.
I
Yeah,
mean,
I
the
think
last thing I would say on that is that I don't think people realize, but 150 million Americans get their insurance this way. So it is a big percentage of the
well,
US population that have these types of insurance products. Yeah.
that's incredible that it's 150 million people still, considering that, I guess what it's probably been 10 or 12 years now since they started mandating employer health coverage and or getting it on the marketplace. But I'm surprised to hear that the number's still that high. It's interesting.
Yeah,
Yeah,
it is interesting.
a lot. All right. Well, I appreciate the backstory and talking about Trusty.Care. I love what you guys are doing. Very like I would say it's a very noble cause, trying to help people with health insurance, because I think it's something that everybody needs, especially in the U.S. With that being said, I would love to kind of dive into a little bit about what we were talking about backstage and what you'd hit on, initially, which is raising money, right? Which is, I think, something that's top of mind for anybody who's founded a technology company, and actually probably for people who founded non-technology companies too, right? Like, I think this is something that all entrepreneurs are dealing with, and we've been kind of in an interesting situation the last few years. I think I remember, when the pandemic first hit, kind of like that first month was like one of the worst months we'd ever seen, and then there was kind of that rebound, but a lot of it's from the from government, I guess, injecting capital into the economy. But I guess generally speaking, last couple of years, what's high level, what's your experience been, dealing with investors and funds?
Um, it's definitely way more complex. That said, we were able to raise in the spring during COVID, as well as in this last summer, which was also a difficult period of time. So there is capital out there, and there are ways to approach investors that can work to raise, but it's definitely more difficult. The investors are needing to weigh, um, do I keep my money in the bank where I'm getting 8% interest, or are you realistically going to get me a better return than that?
Yeah.
And so now they're just evaluating things in a completely different way. So
Mhm.
it definitely makes it harder.
Yeah, and I think that I think that's a really good point, actually, because a couple of the things that I've noticed on my side is that, just like you said, even hey, is it gonna, am I gonna get more money over here, more ROI, if I pull it out of the bank and move it over here? But also, with the market being down recently, a lot of people, even if they think they can get more money investing in your company, they're at a point where pulling the money out of where it's currently at would actually result in pretty significant losses. And so, and that's one of the things that I learned about investing, especially in things like the stock market, is that you don't pull your money out when you're down, because then you end up you don't ever get the ability to rebound from it, and that's really the hard part. So that's one of the things that I've noticed, is that even talking to, not necessarily for us, but for other companies, that I'm friends with a lot of people who've founded tech companies, and that's one of the biggest complaint, or not, I guess not a complaint, but that's one of the biggest observations that I've seen, is that they're like, oh yeah, I got this guy, he's ready to invest, he's just kind of waiting for the market to rebound. And right.
Uh,
Yeah.
uh, keep looking.
Yeah, yeah, exactly. Keep looking. But I mean, that's one of the things that I've noticed, is that, just like you said, to the point of, people, they're looking for places to stick their money, but when the market's down, they don't even want to pull the money out of where it's at right now to move it somewhere else, right? So,
Yeah.
um,
I think that's a good point. There's also what kind of investor are you looking at?
yeah,
Is this an angel investor who's like skittish? Although there are a lot of angels that I work with that are quietly deploying capital right now
mhm,
still, which is really different than a VC whose mandate is to be deploying capital.
right,
But it's, do I deploy within my own portfolio, or do I deploy to new people who are a higher risk.
yeah,
Yeah,
yeah.
yeah,
Well, and I think, to my, the what I was specific, my specific use case was, high net worth individuals,
yeah,
and I think a lot of times, especially as an early stage company, sometimes those are the people that you're dealing with first, right? Because
right.
sometimes VCs or private equities aren't ready to invest. And so you're really trying to get buy-in from that first really early round of capital. It's
Mhm.
almost like it could be considered a friends and family round because you typically have a relationship with the investor. You typically know that they are a high net worth individual and they're interested in deploying capital. And so that's, the least in my experience, a lot of times those are some of the first experiences that people have trying to raise money is with angels or people that are in their orbit. So, and then like you said, you start getting into the VCs and the private equities. That's where they're mandated to be spending that money. But I think one of the things that we've noticed, especially over the last year or so, is really a tightening of the belt when it comes to where they deploy capital. I remember, there was a lot more investment in ideas, uh, you know, even just a few years ago, and now it's really, at least this is my opinion. I'd love to hear what you think about it, but it's really more about um, deploying capital to places where they already see that the company has the product market fit and an established go
Mhm.
to market strategy, as
Right.
opposed to, hey, this is a really cool idea. I think it could have legs. I'm willing to put a little bit of money into this. But I mean, what are your thoughts on that?
Well, one thing I would say is there are more and more first check-in funds that are like looking for deals that are really early. And there's the fund in New York, for instance, and look for those because those funds are taking on way more risk. They usually invest a lot less. Uh, but yeah, I mean, um, my sense of what I've been seeing, in the market with angels or VCs is, um, I guess every cycle there's like a catchphrase that you start to hear from every VC, and now it is pathway to profitability. You should expect in any VC meeting or really with any like um, family office or super angel that that's going to be what's top of mind for them. And what they're really looking for is have you really thought through not how you're magically going to make money one day, but how you're going to be actually profitable in like a realistic time frame.
Hmm.
And that wasn't the mindset over the last almost 10 years, and certainly not the last 5 years.
Yeah, yeah, exactly. Like you're talking about. It's growth at all costs, whereas now it's really more profitability at all costs. But and there's always been kind of this mindset that it's easier to cut costs than it is to get more revenue, right? So it was always like you're trying to spin the flywheel of growth, and then you're like, and it traditionally in the past it was always more, oh hey, we'll deal with figuring out how to make the money later. I mean, you could even look at like examples like Twitter. It's like, I mean, initially I'm not even sure that they had like a path to profitability plan. It was just like, hey, this is a cool social network that like you can write your opinion in 45 characters or less, and then the business plan evolve. Whereas like nowadays I think you really got to have that pathway to profitability established. And then again, I think the other thing too is, especially if you're talking about cost cutting, how do you maintain growth, how do you maintain revenue while cutting costs, and what does it mean to cut costs? So
Right.
it's definitely been a shift in mentality, I think.
Yeah, I've been challenging. I do a lot of mentoring of earlier stage companies, and I've been really challenging them to look at that balance. Like in 2 years, if the market goes in a more positive way, you're not going to get any credit if you're profitable, but you didn't grow at a faster than normal clip.
Right.
So, like, you really do have to say, like, venture is intending to move faster than you normally would, but maybe not quite as fast as, I mean, ideally, they want you to grow that fast and be profitable, but, like, realistically, they're, like, kinda looking for somewhere in between,
Yeah.
but just like, staying in one place and hoping that, like, we can just ride it out is you will almost move out of being a fundable company.
Yeah. And I think what you just brought up is it actually brings me to a really good point that I have a note over here to talk about, which is, do you really need to raise capital? Because, like you had just mentioned, a company that's like, a lot of this is kind of in the eyes of the beholder, right? Like it's like, if you are a healthy company and you're growing above 20% a year, I mean, that's
Yeah,
great by almost anybody's standards, right? Like nobody's going to shake a stick at a company that's growing 20% a year, year over year. So, if you're a company that's got healthy margins and you're already growing, when it comes to raising capital, you really have to ask yourself, do we need this? Is our burn rate more than our current revenue? What are we trying to accomplish with this capital? Because, like you said, as soon as you take that on, the expectation is that that money is not going to sit in the bank, that it is going to fund some sort of growth outside of what your original trajectory would have been.
right.
So I think that's one of the first things is, do you really need to raise capital? And from your opinion, what are some of the things that a founder should be looking at when they're really trying to assess if they do actually need to go out and raise a round?
I think that they need to assess a couple of things. One, like you said, if you're already growing at a good rate, then it may not be necessary for you. And the best case scenario is you grow and you don't have to take in any external funding, and you own the entire company and have a great exit, and you own 100% of the company, and nobody's really telling you, like, is on your back about how to go about that. That's not possible in all industries, so sometimes you do need at some point to raise capital, but I'm finding that a lot of the younger startups are looking at, how do we um, get product market fit in a cheaper way? Test out things without spending $1 million on it, but really know, like, we understand our customer, we understand what they want, and before they take in any capital. And that doesn't mean you build out everything perfectly, but I do think that, like, there's a lot you can do before you get to the point where you need capital. And just a second thing on that is, which I think is equally as important, is only taking in the amount of capital that you actually need for this next part of your journey. Like,
Yeah.
I think it's another thing that's, like, overlooked in this time.
Yeah. I love the first thing that you said. I was talking to a director of product, I guess I should say formerly at Slack. He just moved over to another company, but one of the first, because I was talking about this idea that me and my buddy had, and one of the first things he said, he's like, find the cheapest way you can POC this. And like down to, don't even build the application. Like
Yeah,
like, go hand out flyers with QR codes on them that says, "Hey, are you interested in doing this?" and see how many people scan the QR code and fill out the form on the website. Like,
exactly.
because what you can do is you can do kind of a really crude ratio analysis. Hey, we handed out 1,000 flyers and 6 people got back to us, so you probably don't have great product market fit there. But on the other hand, if you hand out 1,000 flyers and you're getting 500 or 600 people scanning the QR code, like, that's phenomenal response, right? I mean, if you could ever capture even 10% of a market, I mean, I think a lot of people look at that. If it's $1 billion market, 10% of that, I mean, you're $100 million a year company, right? So
Yeah. Make
yeah.
sure in that, though, that you're testing that they're willing to pay something.
Oh yeah, yeah. I mean, 100%. Like, sorry, that was like, we were just talking about, for the, first and foremost, just to see what the interest in the product
Yeah.
is. And like you said, but then you're talking about actually, trying to take it the next step. But the
Mm,
point that we were getting at is that you don't just go out and we're specifically talking about technology products where you're going to go write code someday, but I think this applies for any company, right? Like, if you're trying to build you know flying cars, we had a guy on the show not too long ago who's working on flying ambulances, and
mhm.
same thing. Like, you're not going to go out and build one of those until you find that product market fit, because building those types of products is expensive, right?
Yeah.
And so, and then to your second point about only raise the capital that you need, I think that's really important. And it's also really important to understand, what are you going to spend the money on?
Right.
Yeah. So I had a mentor of mine. He was talking about how he got his first round, and they went out and sorry, Bob, I'm not trying to call you out, but uh, they went out and like the first one of the first things they bought was like a really, this is back when telephones were still part of like the sales conversation, but they went out and purchased like this really expensive telephone system with like the wait music and like all the different lines, and it's like he says looking back on this, like, why why do we need that? Like, what was that useful for, right? So it's,
Right.
I think it's having a good roadmap for how you're going to deploy the money, and like you said, a clear strategy to just to how that's going to actually translate to growth, right?
Yeah. Yeah. Translate to growth and both in however you're measuring growth, but that it is taking you closer to revenue is, I think, part of it.
Hmm.
Um, but yeah, you have first got to prove product market fit if there's interest, and then prove out that someone will pay. And I know we're talking about these are sort of more consumer facing. Enterprise can be more complex. I think a lot of people. So we are both in healthcare and in insurance. It's an industry where I see tons of companies that invest millions in building products, but have no idea how and if anybody in the healthcare space will pay for their services.
Right.
Um, so, like looking at those kinds, maybe not a thousand flyers, but it's like, how do you get the right conversations with decision makers for your type of product before you build anything?
Yeah, no, 100%, I agree with that. I'd love to kind of like shift a little bit away from that, because we only got about 10 minutes left, and I got a couple more
Sure.
things I want to get through with you. So, again, like, just to recap really quick, really important to understand if you need to raise capital, what you're raising capital for, and kind of like what your trajectory is once you do raise that capital. So, let's assume that you're going through you're going through your chart, and you decide that you need to raise capital. What's kind of the next step in actually finding that funding? Like, what are some of the things that you need to do to be prepared to find that funding? And then, where are some of the places that you can go looking to find that, those potential investors?
Yeah, I mean, I think the first thing is being prepared, and the two most important things are going to be do you have projections that are meaningful in the first 2 years? And, as you go out further than that, it's sort of a little bit of speculation, but at least in those first 3 years, that you've got meaningful projections, and that you've got your deck ready to go and a data room ready to go with it, even if you're early on, like your corporate docs, like where you're founded and all that stuff. And obviously don't go out raising until you have a lawyer already set up.
Yeah.
There's a lot. Like, you need, if they say yes, to be ready to just roll, and not, because you can lose an investor in that period of time. And I guess
Yeah.
that brings me to sort of second point of that is like, it's they're looking for more signals of weakness than they were in the past couple of years.
Yeah.
So yeah.
Yeah. Well, and I think too, I think it's really important to understand, like, this is one thing that I've learned too, is that your business is never going to be perfect. If you think that you're going to, I mean, if you check all 100 of your health boxes financially and on growth, congratulations. You probably don't need to be listening to me and Joseph talk about how to raise money, because you're probably quite a bit further ahead than the rest of us. So it's okay to run an imperfect business. I think what you should strive for again is health, and being at a place that the growth that you have is sustainable. And that even if you are at a burn rate, and your burn rate's heavier than your revenue, then that you're at a burn rate that's sustainable. That you have, everybody likes to use buzzwords like runway, and I mean, as much as you probably hate hearing Joseph and I talk about it, if you don't have runway, you're putting yourself at risk, because you're likely not going to reach out to that first investor and get a yes right away.
Right.
You need, I mean, how long in your experience does it typically take to raise a round, and how many no's do you get before you get a yes?
I had one advisor that lectured me even 2 years ago, and he was saying, you're looking for 10 to 15% success when you really should be looking at closer to like 3 to 5%
Oh, wow.
success. And that means talking to a lot of people. Now, he was including angels in that, not just VCs. But I would typically set aside at least like 8 weeks really focused on this process, data room ready, really build your pipeline, and then go out strong, meeting with investors, as many as you can in a very short period of time. And it really depends on what kind of company you are. There's some companies it's going to be 100 no's before, yeah,
Yeah.
and last one's a yes. So if you obviously the more traction you have, and so the more capital efficient you are, the easier it's going to be to raise.
Yeah.
Uh,
Yeah. But I think it's also important to understand too that, for example, again, even if you're a healthy company and even if you have great product market fit and you have a great go to market strategy, um, investors are also investing in things that they see value in, right?
right,
So, and they're also investing in the vision. They're not just investing in the financials and the pitch deck. And so, cool, you might already be making money, and the investor may just not align with what you're doing. And I think the other thing too is, a lot of VCs have, they have kind of their, what's the word that they use, it's like they have, it's not their theory, but it's like they have their focus, right? And
the
you know
thesis, yeah, yeah.
thesis, that's the word. I just went blank there for a second. But that's the thing is, if your company doesn't line up with their core thesis, may not even have anything to do with you. It might just not be a good fit for their investment model and what they're going after, right?
Absolutely. I mean, this is a key thing. Like, building your pipeline means understanding, does this investor invest at my stage? Have they
Yep.
invested in companies like me that failed? Have they invested in companies like me that succeeded? Uh, do I meet their thesis at all?
Yep.
And conversely, like, there are a lot of funds now out there that are dedicated towards funding. Women of color
Oh,
or
yeah.
immigrants. So, like, looking at those as well, I think is important.
Yeah. Well, I think it's important too to understand it, if you are a woman of color, for example, or you're from a minority group, or if you have any sort of, if there's anything that you're doing that, puts you somewhere. I'm trying to think about how to say this, but that puts you somewhere that gives you a potential advantage with some VCs over others. It's good to understand what those VCs are, because they'll likely, especially if you're talking about, targeting minority group founders or women of color, they're going to prioritize you as somebody that they want to talk to, right?
Right,
Because you almost immediately fit into their thesis, so you can get in the door with them. I'm not going to say a lot easier, but that's a great thesis fit for your company with the VC itself, right?
right. And I just wanna call out that, one of my funders, this woman named Jenny Fielding, she used to run Techstars, she's one of the, founders of the fund in New York, put out a document online about how to build a pipeline, if you just look that up. And it really walks you through step by step. It's one of the best things that I think any early stage startup can do, is to look through that.
Very cool. Um, w- Carlos, can you get a, maybe, get a link for that? We can pop up if we have time. I think we're just about out of time, but um, from there, I want to just kind of hyper focus on kind of like the last part of this. I think we're probably going to run over a little bit, but that's okay. So once you actually, decide you need capital, you know where to look for capital, you got your pitch deck ready to go, you've identified some VCs where the thesis fits into what you're doing as a company. What can you expect, in terms of going into the meetings and, actually raising the round?
Right. Um, you know, first, before you get into the room, how to get people, it's a mix of asking your friends, getting out there in the world, and doing your research, so that when you write to a VC, you're a good fit for them, and they can see that. Once you get into the room with a VC, you're usually talking to their associate first, and your primary goal of that first meeting is to give the associate enough information that they can clearly articulate to their partners what you do and why their fund should take interest in you. And if they can't get it, if they're not really understanding you, it's probably not going to go anywhere. So I think
Hmm.
that's something that's really overlooked a lot. And then the second thing that I think gets overlooked is people get nervous because they're trying to raise and they're trying to convince an investor. Um, it's a much better strategy often to just answer their questions directly. And if it's a good fit, it'll work out. And if not, it's not a good fit for both of you. You don't want to get married to a fund that is like a bad fit, for
Yeah.
sure.
Well, yeah, I agree with that 100%. And I think one of the things like we just talked about, you're going to get a bunch of no's, and I think it's really important to understand that when you start taking meetings, that you have your company set up in a way that you can really fully focus on fundraising for the period of time that you need to in order to actually close the round. Because if you're part-time fundraising, I think it's going to take you a lot longer to actually get out there and make the connections. And I
100.
think, yeah, and I think to your point too, I think it is really important to make sure that you're asking them questions as much as they're asking you questions. And I do think it's really important for you to have your pitch and to understand what your unique value proposition is, understand what your go to market strategy is, understand what your product market fit is, like your ideal customer base and everything, right?
Yeah.
And you can practice that, but like you said, I mean, if like if you're trying to convince somebody that that doesn't invest, for example, in med tech or in healthcare, I mean, you're kind of going to be wasting your time, right?
Yeah, totally. I mean, in so many ways, like we found that our business has not been received as well in Silicon Valley. So we've even gone down to the road of like, um, Midwest investors that invest in insurance are our best targets, and they understand us the best. And so, getting really a clear understanding of like almost like the VC market fit kind of is, I think, also yeah, something to do ahead of time. And just a couple of just little quick things. They are going to take more time and diligence, and they really are going to push you on the numbers, even if you're early stage. So I can't stress enough having a really good projections model that you understand, not just your friend who helped you to make it, but that you actually understand.
Yeah.
So it's another thing. Yeah.
Yeah, no, I 100% agree. And I think that's just good business practices. But there is, yeah, Carlos, just run the ticker. I think that's important. So, guys, this is what Joseph was talking about. Jenny Fielding, she has the build a pipeline that Joseph was talking about. So I think it'd be interesting for those listening in to maybe check her out and check out the information that she provides. But yeah, just kind of going back and wrapping up on that is that it's great business practice to have your financials in order, but there is absolutely going to be I think they call it like information at the ready. Like there is things that an investor is going to reach out to you, and you should be able to turn around the information requests from them. I don't know what the standard is, like what 24, 48 hours max.
Yeah.
Like you should be able to just like rapid fire off the information that they need.
Absolutely. I mean, we lost an investor last year. I was away on vacation. They asked a question. Somebody, I like just got lost in the shuffle. And when I got back, I answered, and she was like, too long.
Yep.
Um, and fair enough. Like it was, they really want to know that you know these things and have them already prepared. Early stage, you don't have to like go crazy with your data room. And you can look up ways to build a data room. But there's just some basic things that they're going to be looking for that you have to be able to just send them as soon as you possibly can, like competitive field, a couple of things like that.
Yeah, no, I agree. Well, Joseph, we are absolutely over time, but I appreciate you stopping by and chatting with me. It's been really informative. Hopefully some really great information for those listening in. I certainly found it insightful. So I appreciate you stopping by, and taking the time to chat.
I was glad to be here. And on a high note, capital is out there. People are raising capital. So don't get discouraged if you're getting no's. Everybody gets no's.
Yep.
So glad to be here also.
Yeah, appreciate it. Carlos, before we go, you got any more announcements for next week?
Yeah, that is correct, Eddie. First of all, on Monday, we're scheduled to talk to Jonathan Curran. I'm sorry, I forgot the name here, but it's Vice President of Cybersecurity and Engineering at QCR Holdings. The name is Jonathan Curran. And then finally on Wednesday, we have also confirmed Stephanie Cox, the CEO of Lumavate. So Lumavate, I'm sorry.
Lumavate, yep.
Lumavate, exactly. I'm sorry about that. So that's what we have. There might be one more for Friday. I'm yet to confirm, but it'll all be there up on the show's website. So keep an eye on it. And remember, join us right here on Tech Backstage every day or almost every day at 12 p.m. Pacific time. Remember, be here or be square. Thank you.
Thanks, Carlos. Thanks, Joseph.